Hi everyone, I hope you're having a great time so far. With great pleasure, I want to welcome you to the next session, Bridging TradFi and Crypto, Work in Progress. In the exciting worlds of TradFi and crypto, there is a mix of similarities and differences in products and clients. We've got experts from both sides ready to chart and compare insights. Please welcome the moderator of this session, the Chief Operating Officer of Solidus Labs, Arad, who will introduce his panel. Hen, the stage is yours.
Thank you very much, Despina. By the way, I don't know if you've noticed, but Despina is absolutely amazing. Thank you for everything. It's a pleasure to be here. My name is Chen Arad. I'm a co-founder and Chief External Affairs Officer of Solidus Labs. We're a crypto-native market surveillance firm. But today is not about me, it's about our expert speakers. I do apologize, one of our speakers is running a couple of minutes late. He'll join us momentarily. We're here to talk about crypto and TradFi, a work in progress bridging those two. And a very relevant conversation for this conference, I found, based on the many conversations I've had while I was sitting here. But before we start, let me ask our incredible speakers to introduce themselves. Cassandra, maybe starting with you.
Thank you very much, Hen. Cassandra Cox, representing LMAX Digital. I'm in the sales team there. LMAX Digital is a cryptocurrency trading venue, which is part of LMAX Group. I'm hoping at this conference a lot of people here may be familiar with LMAX Group. We're a large FX CFD provider and have been present in the market since 2010. And so it's very exciting to be talking about our two businesses and how we look forward to merging TradFi and crypto.
Talk about the work of bridging crypto and TradFi. There you go, John. Right on time, fashionably, as always. We're just doing a round of introductions. Gareth, over to you.
Thank you both. Hello, I'm Gareth Hughes. I run the exchange Zodia Markets. Zodia Markets is a majority-owned subsidiary of Standard Chartered Bank, so very much bridging the TradFi and the crypto.
If you could raise the microphone a little closer.
A little bit closer. So we're a majority-owned subsidiary of Standard Chartered. Standard Chartered has two crypto businesses, interestingly, both called Zodia, a custody business and a markets business. On the market side, we have an OTC business and an exchange. It's very relevant for us here, obviously, given the bridge and given the type of clients who we think need access to crypto via regulated, reputable venues such as LMAX and Zodia. So I'm very excited to be here and interested to have this discussion.
Thank you. John, last but not least.
Hi, I'm John Salmon. I'm a partner at Hogan Lovells, and I lead our global digital assets and blockchain practice. I'm very sorry for being late, and very sorry to my fellow panelists for also being late. I vaulted, if it gives you any comfort, I vaulted over the big central barrier. It was a bit higher than I thought to get here. I was sprinting. The taxi man said, if I drive down there, it's going to add another 10 minutes. So yes, a little bit, anyway, got stuck on a call talking about digital assets, so apologies. But I'm here now and very much looking forward to the conversation. Yeah,
well, and I think a lot of the conversation today is exactly about getting past barriers, breaking them, climbing above, or going under. So I was really excited for this panel because obviously this is a very important conversation. Generally, there's, all of us talk with a lot of people in the industry. There's a sentiment that what we in the industry call crypto winter, we passed the worst and we are heading up. And of course, with that often comes a lot of business, a lot of interest. And so we hope we can provide helpful insights for anyone who wants to engage and help build this bridge. So let's start with, kind of like the simplest question. You all spend a lot of your energies day to day and you bring a lot of expertise exactly doing that, building that bridge. Obviously, we have a strong legal perspective, we have a markets perspective, we have a business development perspective. Let me ask you, by starting a simple question, and by the way, also important to say, you all have significant traditional finance experience as well. So what's the difference? What are some of the biggest challenges for the many here who might be looking to offer crypto services, through their platforms or thinking about a crypto strategy? What's your crypto 101 to them? Where should they focus? Where can they start? And maybe start with you again, Cassandra.
It's very interesting. So what I would say is, first of all, crypto, just like any of your traditional asset classes, represents a return structure. You're looking at providing a source of alpha to your clients and trading opportunities. So the net beginning of the conversation is very similar to every other asset class you're looking at. There are some particular parts of crypto that make the onboarding and the initial journey a little more complicated. However, the industry has worked really hard to provide tools that you could deploy quite quickly. And what I mean by that is if you wanted to buy a Bitcoin and you'd never bought a Bitcoin, you'd have to think about how you were going to hold that Bitcoin, with whom, and would you do it on behalf of your clients? Would they do it themselves? Now, all of these questions have been solved by the industry, and there's a lot of great solutions out there, Zodia custody and our own custody solution being one of them. But what I will say is the market is also prepared with tools that you could deploy today. So if you're trading equity CFDs, FX CFDs, you could deploy crypto CFDs on your platform very easy. There's also a lot of other derivatives available that can avoid having to hold physical Bitcoin. So, we shouldn't be scared of joining in and looking for the return profile of crypto, but we should be very aware of accessing the products that are most suitable to our clients and to our workflow. And probably one of the most interesting parts at the moment is which jurisdiction you're going to do that from, but I will leave that for John.
Always good to have a lawyer. So maybe on that note, John, over to you.
Yeah, I mean, I think totally agree with what's just been said. The challenge is at the moment the kind of constantly shifting regulatory environment and the difference in, as you said, in all the different jurisdictions. So, if you are at a very large institution, I think the appetite to do digital assets in the broadest sense, and we can maybe come back to talk about differences between all the different asset classes within that frame of reference, is really there, but they're also scared, right? And they're scared of what are compliance going to say, what are the lawyers going to say, what are our regulators going to say. So it is that, I think, is unfortunately, or fortunately, depending on which side of the fence you're looking at, is actually the biggest barrier, is just trying to get people comfortable with that. And that is, in many ways, not difficult, and in many ways, really difficult, because, as I said, I think things are shifting and changing. You get proposals, we probably get stuff every day from somewhere in the world that's deciding to do something in a slightly different way. So just trying to keep on top of that is really important. So, but it's like anything new. I've been doing fintech, what's now called fintech, for 25 years, and no matter what happens, and we saw this at the beginning of the internet, because yes, I am that old, pre-internet, then people get freaked out about new things, and they worry much more about the new things than they worry about their current business practices, which actually could be more risky, right? So it's just making sure that people understand what they're doing, understand the risks, and go with their eyes open. But that we're all used to doing that, so it's just I think it's a psychological as much as anything to get over.
Yeah, no, I think it's a great point. I specifically want to emphasize, I try to emphasize it wherever I speak, that let us not forget that the risks, the complexities, the challenges, many of them, definitely crypto didn't invent them. They are unique in certain ways in crypto, but they were unique. They're unique in other places and exist in other places before. Gareth, to you, what's your 101? Where should people start thinking about this industry?
Look, I guess the way people view the crypto industry will inevitably be colored by where they're from. And I don't mean geographically, I mean from market's perspective. Somebody with an FX background, which is the majority of people in this room, think of it like a currency pair. Often people with an equities background think of it like something that trades on a centralized exchange. Crypto is different, but not that different, right? So from a market structure perspective, there's many, many similarities with the FX world and some with the equities world, for example, the listed futures world. What I would say is where people tend to start is typically, where can I keep my crypto? Where should I custody it? And that's a key question you should answer yourself. You should consider yourself whether you want to, as you say, own your own wallets, host your own infrastructure, use a custody provider like a Zodia custody or an LMAX custody, or trade on the basis where you leave your assets at an exchange. We tend to find for the institutional market that the segregation of duties between a segregated, often regulated custody provider with bankruptcy protection, allowing you to trade on venues or in the market, is typically the way people think about it. So we tend to find with conversations with people who are considering crypto as an asset class, once they've considered they want to trade it for alpha generating purposes, how to do it, then understanding the difference between custody and execution is one thing. And then another thing to think about is this concept of exchanges. We use the word exchanges. My job title is head of exchange. But what we really do in crypto isn't really exchanges, okay? Not by the TradFi sense. There's generally speaking no clearinghouse, albeit that's changing. So people get, I think, a little bit hung up on trying to understand that market structure. Really, there's a bunch of OTC providers and prices in the market. You can trade with them directly. You can trade them on venues. Some of those venues look and smell and act like FX venues, so much of it will be very familiar to you. What I would say is there are now a good number of reputable TradFi experienced service providers in the market, and I mean that from a market infrastructure perspective, a trading and a custody perspective. So it won't be difficult to find people to speak to about that. We're just some of the examples. There are many good people, but understanding that segregation and the structure, your decision about where to custody, how to custody, and how to access the market is probably the first one of the 101.
Yeah, and I'll piggyback on your point there and just say another thing that I try to always emphasize, you alluded to it, I mean, we work with market surveillance teams today in crypto, of course, focused on preventing market manipulation, that are larger than some of the market surveillance teams in large traditional financial institutions and are staffed by people from NYSE and NASDAQ, et cetera. So in that sense, I think I'm going to keep on going back to that imagery of a bridge. 5 years ago, I think it was fair to say there's a need for a bridge. Today, I think the bridge is mostly there. Maybe we still need to build guardrails so that it's a little harder to slip off, but we're not far from it. And you know what? I meant to go into it a little later in the conversation, but I actually think now is a good opportunity. We generally group a lot of things under this term crypto. But there's kind of like a bridge to the next step, like a further bridge into what we call DeFi, decentralized finance. Most of crypto today, we love to talk about decentralization, and the assets are decentralized. That's really the heart of the innovation. But the vast majority of activity is centralized, takes place on centralized order books with private data that obviously has connections to the off-chain public data side of things. But if I kind of double click, as they like to say in Silicon Valley, please forgive me, on this question of DeFi, where do you see the greatest opportunities there? All the way from stable coins, tokenized assets, which of course is a big deal right now. Let's take that. Let's start crossing that next bridge together. How about Gareth? I'll start with you this time.
Sure. So, being open, we're a FCA-registered subsidiary of a bank. So for us, dealing with the DeFi world is quite difficult because we need bluntly, we need an entity we can regulate, we can understand, we can put our arms around KYC and understand where it is. So for us, dealing with the DeFi world is quite difficult. And I think the DeFi world, which is effectively for people here who, if I can oversimplify it, it's where execution happens on chain as opposed to execution happening off-chain and then being booked on-chain afterwards. Think of it like that. I'm hugely oversimplifying, and I'm sure many people know more than me. But that's how the majority of the crypto world executes. It executes away from the chain and is booked on-chain afterwards, usually in terms of net settlement. We find that is the way that most people want to access the DeFi world right now. So we're almost see ourselves as a bridge, right? We can bridge into the DeFi liquidity various ways, and then we can make that liquidity available from a centralized point of view to clients. I personally think that for mainstream institutional adoption, DeFi is a step too far in the short term, and we shouldn't be pushing that. As you say, decentralization is a term we all bandy around, but from an execution perspective, it's not something we interact with on a daily basis.
Fair enough. I'm trying to see who looks more enthusiastic. I think, Cassandra, you win.
Well, I am, because I always like to be a little contentious. I think we have a slightly different view, and I think that's just because we're a different part of the market a little bit. LMAX is a fintech provider, and we view DeFi as part of the technology solution to bring tokenized assets to the foray of trading. So when we look at solving this problem, we're doing it via, and actually LMAX is very heavily involved and has a decentralized trading app that we're deploying very soon. It's been, in progress for a while. And when we look at the environment and we can see what stops FCA regulated players getting involved today, what we're trying to do is make the technology innovation that DeFi brings, the ability to move your assets real time and interact with a number of different peers into a more KYC, AML friendly environment. And that, I think, will enable us to move to the next stage. And I think that's the wave that Gareth referred to as in missing, is at the moment in DeFi, it's peer-to-peer, anonymous matching. There isn't any KYC. You connect your wallet and you trade. I mean, it's great, but that's not going to be fit for purpose for a regulated institution. So there's a lot of players, ourselves included, looking to solve that problem to speed up how to bring tokenized real-world assets into the trading environment more quickly. So it's sort of the same response. It's not there today. It's just there is a lot of work being done, and we're pretty excited about it.
Right, and of course, a lot of the question around DeFi is legal. There's like an active conversation. Obviously, regulators are involved. Can anything be truly decentralized in the sense that no one is responsible for it exactly? But I'll let you, John, tell us what you think are some of the kind of core points of interest there.
Yeah, I mean, we've been looking at DeFi propositions for a number of years now, and I think that the challenge with DeFi, and I'm going to agree and not agree with Gareth, actually. So I agree with Gareth in the sense that one of the challenges that we have in this space is the terminology. And DeFi is, and as I said, you have to go into all of this with your eyes open as to the risks. And the terminology is often not actually equating to what's actually happening. And DeFi is a classic example of this. A lot of what is so-called DeFi or decentralized finance is not in fact decentralized and does have a party who is broadly in control. And what we've always said to clients that come to us with decentralized finance propositions is, if you have an element of control or you're making money directly or indirectly from, say, a protocol, then the regulators are going to find some way of getting to you. Not necessarily today, but probably tomorrow, in a year. And that I believe firmly. So you've got to really think about, is it actually decentralized or not? If it's truly decentralized, then you've got a real problem from a legal perspective, because financial services, as you all know, always really goes through gatekeepers, right? And the gatekeepers are all regulated. If you don't have an entity or a gatekeeper, then with decentralized finance, you have to either invent one, effectively, which is, so if you look at what's going on in the EU with MiCA, they're basically saying you cannot be in the EU unless you have a legal entity that's set up in the EU. So decentralized finance under that regime is not allowed. Similarly, you've got in the UK a new financial promotions regime that says, if you want to carry out certain activities and promote anything to do with crypto assets, then they have to be signed off by a regulated entity in the UK. So, there are various ways of trying to get at this. The bit that I would disagree, I think, with my fellow panelists about is institutional adoption of DeFi. We actually see, again, a real enthusiasm for it with clients, actually. And if, I won't go into detail about some of the projects, but one that, is probably released about a year, 18 months ago was SocGen did a bond using the MakerDAO decentralized, so there is, I think, there is appetite for this, and if you can get it right, and that was a very complex transaction, some great papers on it if you want to, it's all public knowledge. So, I think financial institutions see DeFi as very interesting, a very interesting way of going about business, making things more efficient, just as they do with digital assets. And I think there is enthusiasm for it, and I think what we need to figure out is some form of regulatory certainty about DeFi, but that is some way away. You're probably talking about 5 years away, because we've got a whole lot of other things in the queue before that.
And actually, John, just to add to that, a newer example is Citibank actually did an on-chain FX trade recently, which, is hugely encouraging to the market that A, a name like Citibank is doing it, and B, that they're using tools we understand. Now, FX is very close to this conference's heart, and to see FX trades going through on chain, we're very excited by. I think all of us can take a step back and then see how we do it today and how we could do it in the future. And I think that's why these use cases or proof of concepts are really very important. And, you know, I think it will take time, but I think there is a will behind it to really push through and try and, you know, take the innovation forward.
Right. I mean, I just came back from Singapore, where the Monetary Authority of Singapore announced a new project called Guardian, in partnership, if I remember correctly, with JP Morgan, right, who have their in-house built blockchain called Onyx. That you know, they're working with the government there in order to try and bring some more assets on chain. So very, very exciting stuff happening. Before I jump into some of other topics, I'm curious to ask if there are any other, particular products. If we're going to, stick to the products, and what are some of the most compelling use cases that you like to mention? Another thing that happened in Singapore is someone mentioned this idea that in some ways the crypto industry has been, for a large part of its existence, a solution looking for a problem. So I'm curious if you have any response to that. Are there any other interesting products that solve particular problems? I'll throw the word stablecoins out there, but you don't have to stick to that. Anything you guys want to push? Gareth, maybe?
Sure. Stablecoins. Thank you for that. So having been bridging into crypto for a while, I've probably used the word tokenization in the region of 500,000 times, right? And I think there's been an awful lot of talk, just as we come into every new year, about this is the year of tokenization, and tokenizing an asset inevitably is something good that we should all be doing. And tokenizing an asset is only something you want to do if it democratizes access, increases liquidity, or increases efficiency. And a lot of tokenization projects haven't done that. And while there are a lot of good proof of concepts going around, an immediate use case we see in Zodia is stablecoins. Funny enough that you mentioned there. Now, the answer to the sort of solution problem is interesting. No one wants to be in the business of building solutions for problems that don't exist, but sometimes that's what happens, right? The air conditioner was built, apparently, I learned this the other day, was built to keep reams of paper cool, right, in a factory. And the home usage of it and the sort of residential uses only came later. Now, I'm not suggesting that we should be building technology and waiting for building solutions and waiting for problems to come along. But an immediate one for us is stablecoins. It's baffling to me that the global FX multi-trillion-dollar market effectively operates on office hours, right? And there are times of the day when you can't settle trades. It's never sat right with me. Now, that doesn't mean that we can solve that with stablecoins, but it means that a stablecoin is effectively, what I can see, the most basic use case of digital technology, where you're simply creating a digital version, you're putting money on the internet. Now, I know that sounds like something my dad might say, but you genuinely are putting money on the internet. How it's not possible to send money as quick as a text message, I don't understand. So stablecoins, before you even get into creating a parallel FX market where people can use them to speculate, stablecoins are what we see as a huge growth area in terms of cross-border transfer of value. Now, I'm talking about corporates paying subsidiaries in Africa, or payments providers, of which there are many here, using stablecoins to avoid going in and out of dollar, right? That's a huge growth area and something that we're very focused on in Zodia. And we're not the only ones, right? We haven't invented the idea. So stablecoins are, for us, the area, not tokenizing gold or real estate, or all of which are valid use cases, and there are people doing that. The application of stablecoins to real-world international transfer of value is where we see a huge opportunity.
Again, trying to see... John, you jumped.
Okay, I'll try and look enthusiastic. Very difficult for me being Scottish. But anyway, I mean, we were having this discussion whenever we last spoke about it, but what we see in the big institutions at the moment is that classic tokenization of real-world assets, right? And that is people trying to do what they do today quicker, faster, cheaper, right? But like the bionic man version of financial services. So I think, but an important component of that, which I think people forget, is you need to try and be able to, so you obviously can use some sort of DLT-enabled blockchain type thing to transfer the assets, hopefully better and cheaper and more efficiently, but you also need to transfer the money. And that's sort of what people forget. And actually, the missing component often is not the tokenization of the real world asset, but it's actually the payment bit, because absent Onyx, there aren't actually, from a kind of B2B perspective, that many ways of transferring the money. So, so I absolutely agree, stable coins and, again, terminology is important, what you could call digital cash, or you could call, DLT-enabled cash deposits. There are lots of different ways of saying this, and as a lawyer, definitions matter, unfortunately for me. So, but that I think that payment leg, as well as the settlement of the asset leg, is really important.
Cassandra, anything to add?
I mean, we agree. Without having a wholesale CBDC, we need an on-chain form of money. And at the moment, it's privately generated stablecoins are what we've got to use. And we don't want innovation to slow down while we wait for a CBDC to come. Launching a digital CBDC is going to be a complicated process for any central bank, who's going to have to do a lot of industry work with people in country and in other central banks to be able to make sure they're interoperable. There's a lot of technical details to solve there. And in lieu of that, while we wait, we do actually agree stablecoins are going to be the best way for us to operate and move the technology forward.
Okay, great. Really interesting stuff. I have a bunch of other buzzwords that I could throw in and see what you have to say about them. But let's switch gears to another topic. I think another thing that has happened in the crypto industry over the past 5 years, part of this maturation, is also an acknowledgement of a lot of the challenges. And I think we'd be remiss when we think about this bridge if we don't touch this question of credibility. Exactly a year ago, I was here at the Finance Magnates Summit, and I had the honor of hosting a conversation with Lisa Cameron, Member of Parliament. She heads the all-party parliamentary group on digital assets. And at the time, unfortunately, we spent a lot of the time talking about FTX and the downfall and what it meant for the industry and how do we make sure it doesn't happen again. Obviously, a lot of time passed since the industry, has been responding and working to build trust. And I'll just mention that just yesterday, a big piece of additional news came out, and that is that Binance, the largest crypto exchange in the world, really a pillar within the industry, the CEO has reached a plea deal, admitted guilty. Changpeng Zhao, known as CZ, admitted guilty for various charges in the United States and resigned. From what I've seen, there's actually the industry has been shaken by it, but there's a lot of positive response as well, kind of seen as part of, as an important responsible step to help the industry move forward. Curious, not necessarily on the Binance point, but this general credibility point, where you think we stand, compared to last year, or any other thoughts. How about John? This time I'll start with you.
Yeah, I mean, I think the important starting point on this is, so all of the scandals that have happened, a lot of them have happened not because it's crypto, but the policymakers and regulators have been poor globally on dealing with crypto. Right? In 2014, there was a report by the EBA, European Banking Authority, on what could go wrong with crypto assets. It's a great read, if anyone's interested, but it is actually quite punchy, and it has and all of the scandals can be linked back to all of the things that they predicted. And that was the kind of precursor to what's happened now in the EU. Unfortunately, a lot of the policymakers and regulators, and we are guilty of this in the UK, the US are certainly even more guilty of this, basically did not want to regulate crypto because that in itself would give them credibility. And you'll have seen the ex-chair of the FCA wrote in the FT, I think 2 or 3 weeks ago, basically saying, I don't like all this crypto asset law that we're proposing in the UK because it gives crypto credibility, and we shouldn't give it credibility. But the problem is, if you don't put in regulation, that encourages bad actors, right? And I think, from my perspective, what I've always argued for is a proportionate, agile piece of legislation that actually gives the industry credibility, makes everyone, means that there are no, there's no one arguing that, oh, well, it wasn't totally clear to me, therefore I just did whatever I wanted. I mean, that is not a great argument before a court, right? But it's certainly one that I've heard. So make it very clear, and that gives institutions much more confidence. It gives you guys much more confidence. It gives customers more confidence. It gives the insurers who insure all this infrastructure much more confidence, and means that the industry will flourish versus, bad actors coming in and doing bad things and trying to take advantage.
Right. Yeah. I mean, there's a need for lines in the sand because, it's much easier to know how to well behave when you know what's wrong behavior, and you're starting to really see those lines in the sand. Unfortunately, some of them are being drawn through litigation, but that is a form of dialogue between industry and regulators, and there are a lot of other ways in which it's done. But sorry, but Gareth, what are your thoughts on this credibility question?
Yeah, no, I can't pretend that major scandals aren't both good and bad for people like us, right? Yeah. They're bad because they shake the confidence in the industry. They're good in the sense that they're shaking up bad actors. And it's important that we point out that the majority of these are bad actors, not bad asset, right? What has happened on FTX and 3 Arrows Capital and Binance and all these other ones, generally speaking, could have happened in any asset class, right? The actions, maybe that's slightly vague, but the actions which were taken, often fraudulent and non-compliant actions, were not specific to the asset class of crypto. And there is a general shakeout. As you say, maybe this is the line in the sand, but I don't think there is a line in the sand where we all move forward clean. It's a gradual shaking out of the industry. It's a gradual improvement of the industry, and it's a gradual move towards a regulated, insofar as it can be regulated, industry. But crypto is not going to become less regulated. It's going to become more regulated. I'm old enough, maybe John and I are about the same age, I don't know. I'm old enough to have worked through the first .com, right? I worked for Cisco Systems in the early 2000s. And there were all sorts of hubris, and we all got a bit excited about what the .com was going to do, and all my friends left to join .coms that don't exist anymore. But no one seriously thought the internet was going away, right? And over time, it's become a more regulated, for better or for worse, sector. That'll happen with crypto, and whether that's through the stable coins, whether that's through governments adopting and allowing digital transfer of money, isn't entirely clear. But every one of these scandals that we see moves the industry forward, and I think I don't see it as good, but it can be positive for the industry as a whole.
I mean, the scandals could have happened in any other asset class and has happened. I mean, Lehman Brothers was a fully regulated bank, right? Let us not forget that. Cassandra, what are your thoughts?
I mean, at LMAX, we've always run our digital business very much in line with our FCA-regulated brokerage business and our exchange business. So I guess when we look at it, there are choices that individuals make along the way, and we welcome regulation coming in to provide security to investors. Because what we've seen in some of these activities is maybe people weren't completely aware of what was going on within the firms. And actually the regulatory frameworks and the requirements that regulators will put on the firms can give the ultimate investor more protection, and really that's what we're looking for, is for investors to be able to have a safe and secure place in which to invest in crypto. And I think the credibility question is something that happens in any nascent asset class. It happened in derivatives over history. It goes throughout time, that actually you'll see the innovation come first, and regulators can't keep up with it, but they will, and they do catch up. And we see a lot of work being done in the legal system throughout the world, and we often need a lot of court case law to be able to help advise the regulators. Otherwise, I mean, I always thought it was quite interesting, the SEC doesn't decide what a security is. The courts do, and then the SEC follows suit. So when we say there wasn't regulation, I guess it's more that it lagged the innovation, because we needed to get almost, these scandals are helping, because it brings it to the court. Judges make decisions, they make definitions, it becomes case law, and then we can move forward. So, the journey is very much what we've seen throughout history, and it's, going to continue.
Thank you. We have a few more minutes for the panel. Before I launch our little finishing speed round, I want to ask if maybe there's a question from the audience that anyone is interested in asking. I see a hand over there. Yes. We can't hear anything.
Check, check, 1, 2.
Now it works.
Okay, very good. Yeah, I think for the panel, guys, are very interesting. I want to get the panel's take on the what's going on with the SEC. You mentioned Binance, but I also know that Kraken was sued for unregistered securities operation, just like Coinbase was, and the whole concept around regulation by enforcement. So how is that impacting the US versus how that's going to impact Europe is kind of my question. Thank you.
Anyone has a strong appetite to respond to that?
I will, yeah, I mean, I think the US is really in danger of being completely left behind. And, you know, in a way, I don't think they care. Gary Gensler doesn't care. Gary Gensler, you know, chair of the SEC, he is very anti-crypto and thinks that it's all a scam. So he wants the industry completely shut down in his personal view. So regulation by enforcement is the way that the US do this. You know, as he said, there's case law that develops. That is not the way that we do regulation in the UK, in the EU, and in fact, most other places in the world. You know, so the US lacks guidance. The other problem that you have with the US is you have lots and lots of different regulators who all want to, you know, there's probably 6 regulators that you, from a federal point of view, you need to worry about, and then you have to worry about all the state regulators, and the states themselves are all coming out with their own laws. So I actually did a panel with the commissioner of the New York DFS, and she was talking about, because they put in, they have crypto laws, they have crypto regulation with clear guidance, etc. And her argument was, actually, we have encouraged innovation and we have got consumer protection because of that, right? Because you know, people look at regulation and think it's a break to innovation, but it does encourage consumer protection. And her argument was, no, that's not right. And I completely agree with that. I buy that. You know, I think having clear regulation with clear guidance will help. So I think Europe and the UK, Singapore, Hong Kong, we were having, again, Chen and I, we geek out about this stuff a lot. We're having this discussion, and those are the jurisdictions that will progress together with lots of others, and the US is going to be left behind. And I don't think they care right now, but they may care in the future, and we'll see whether they legislate particularly for that.
Thank you. Anyone else want to add anything quickly? All right, so I guess we are running out of time. I'll just ask you very quickly, if you have any kind of last couple of sentences, what are you going to be focusing on in this coming year, or what do you think is the most important thing you want to leave the audience with, as much as possible with the two, 3 sentences? Maybe Cassandra, starting with you.
I mean, I think if I was looking for a signal in the next few months, I think, and we haven't touched on it, but it's big news in the market, is the spot Bitcoin ETF approvals are hugely important. Look to that for guidance on where the US is going. They are lagging, and it's true Gary Gensler isn't interested, but I think this particular application process will show us a lot of where we're going to head in the next year.
Agreed. Gareth.
Swap ETF, as those get approved, when big names are getting those approved, that'll be a huge impetus to the market more generally and to the retail flows and stablecoins. I genuinely think in a year's time, if we're all here in a year's time, we'll be talking about stablecoins, and everybody in this room will have much more understanding of them, and there'll be a good percentage using them. That's our position.
John, last word. With great power comes great responsibility.
So 2 sentences. First one, I think we will see more institutional adoption, more institutional use in the next year. We say that every year, I know, but I think we will, what we see is things definitely moving out of the lab into the real world. And I think secondly, we'll see a lot more specific regulation coming through and actually being implemented and enacted. We'll see MiCA come on board. We'll see the UK come on board. You know, we'll see some of these major jurisdictions with some helpful legislation.
Thank you. And on that optimistic note, join me in thanking our builders and shakers of a safe and regular crypto industry. Thank you very much.